guys, it's Marshall Sparkman. Let's do a quick weekly update with you guys, and I'm going to explain things in simple terms. First thing I want to talk about is the 10-year Treasury and why it's important for mortgage rates. Basically, it's the U.S. government borrowing money for 10 years. It's the yield, the interest that it pays to people who lend money. So if a bank needs to borrow money, they go to the federal government and they pay whatever the current yield is. So why does everyone care about the yield? Because it's considered super safe. It's like the baseline pricing for long-term money. Lots of other loans look at it and decide how they're going to set their interest rates. So let's talk about how that connects to mortgage rates. Lenders start with the 10-year yield because that's what they're borrowing money at. Then they add a cushion for risk. Think about late payments, paperwork, profits. The bank's got to make money and they got to pay all their staff. They call that cost of servicing. So the add-on is called the spread. So if the 10-year rate plus their cushion, usually a couple percentage points, then if the banks, for example, can borrow money at 4%, then they're going to turn around and lend it to you for about 6.5%. Just as an example, if the banks borrow money at 4.5%, then they're going to have to loan it to you at, say, 7%. So what happens when the 10-year Treasury goes up and down? If the 10-year Treasury goes down, that means money is cheaper for banks, and that means lower mortgage rates, okay? If the 10-year Treasury goes up, the money is more expensive, and usually the mortgage rates will follow along with that. And that's a rough guide. It doesn't follow exactly, but it's close enough. So for every 1/8% change in mortgage rates, it's about $25 per month for every $300,000 borrowed. So every little bit helps, right? Now let's get into the mortgage application data. Mortgage applications have jumped 9.2% this week. This is the largest jump we've seen in a long time. People are applying for more mortgages than we've seen in a while, so people are starting to hit the market. I think we're going to see that on the streets, and you guys are probably already seeing it. Talk about inflation. PPI came in a little bit cooler. Why do you care about PPI? So it's basically what businesses are paying for stuff, right? If their costs rise, it usually means there's less inflation. What about the feds? Next week, the feds are having a meeting on the 17th. We're expecting them to drop rates by 1/4%. We don't know how that's going to affect mortgage rates because the Fed rates control, think about credit cards and HELOCs and that kind of stuff, not necessarily mortgage rates. Geopolitically, we've got a wild card. We've got a lot of stuff going on, within the culture, worldwide. So that could affect things always. If you're thinking about buying or refinancing, DM me and I'll translate today's rate into a simple monthly payment and show you how small rate changes and movement can help you be a more informed buyer, or if you're looking to refinance, give me a call. Let's run the numbers.